Dipan, thank you very much for joining in. We also have Ajay Vora, Head of Equities and Nuvama Asset Management, joining in on the discussion now. Ajay, over the past 3 weeks, we've had numbers across sectors: IT, private sector, financials, auto names, whether it's two-wheelers or even four-wheelers like Ashok Leyland, consumer names, paints, HUL, etc. Can you tell us the top three takeaways from the earnings season, according to you, in terms of trends?
So good afternoon, Rima, and thanks for having me. So broadly, if you look at the overall result season so far, clearly, IT sector has been a bit disappointing. On the banking side, as expected, numbers have been pretty strong. But, there is a caveat to this. If you look at the net interest margins for most of the banks, they have been pretty high since a while now. And broadly, if you look at one of the largest private sector banks also, the NIMs are in excess of 5%. So I think the view that market has taken on the overall banking sector is that it is unlikely that the profitability of the banks in terms of the NIMs is likely to expand from here. And if falling inflation will have some sort of impact on the overall credit growth also, then looking forward, if you look at what we had 17-18% credit growth, can come down to around 12-13%. So in spite of really strong numbers from say ICICI or other banks as well, we are seeing muted price performance in a way. So that is on the overall banking side, but auto definitely has surprised on the upside a couple of names which has reported so far. But if you look at the ground level, there has been some sort of higher inventory, and now anyways we are into the monsoon period. So going into the festive season by the end of the quarter, there can be some sort of discounting or some sort of lower production. So my sense is that although the numbers have been great, stock prices are not reacting to those really great numbers because people are not really much certain about the outlook at least for next 6 months or so. Apart from that, there will be certain bottoms up stock stories where the numbers have been phenomenal and the stock prices have therefore done pretty well. But at an aggregate level, if you look at it, there has not been a major upgrade as such, and we have moved pretty quickly in terms of our valuation. So if you look at March end, we were somewhere close to 16 times for the broader market. Now we have quickly moved to almost 20 times FY25. So to that extent, the upside on the valuation is also pretty much limited from here on.
Ajay, interesting you mentioned that because I was just going to touch on this. When the Nifty crossed 19,000, it did so with momentum. The journey from 19,000 to 19,500, it was sort of pretty rapid. And then 19,500 became the first resistance of sorts. And since then, now there's been a fair amount of back and forth. So what do you think has changed? Like you mentioned that, valuations, suddenly that whole argument is coming back on the table. So what's different? What do you think are the key triggers in the near term?
So honestly, on a 19,000 base, 400, 500 points would be like 2-3%. So it's very difficult to, take a call on 2-3% movement in the market in terms of valuation. But broadly, I feel that, I think maybe sometime back when we had a conversation, FIs were pretty much underinvested in India if you look in the month of March. Having sold close to 40-50 billion dollars over 2 years, their holding had come down pretty significantly to 17.5-18%. And therefore, if you look from the month of March till now, both primary and secondary market put together, they have infused close to 18-19 billion dollars, which is a really big amount in a short span of time. So, therefore, the valuation re-rating has also happened, and I wouldn't say that we are trading expensive right now, but we are fairly, at a mean valuation of around 20 times, where the pocket of opportunities are now pretty much limited. So you had, something like an auto and a pharma, which were trading pretty cheap maybe 6 months back. But broadly, now somewhere the upside is there, but pretty much limited, not what it was earlier.
Hi Jay, good afternoon. Nigel on this side. Ajay, when the last time we spoke, you gave us a couple of sectors and stocks that you liked. I think you mentioned about pharma and Glenmark. I think was one of the names we discussed. Tell us something new. What's looking good?
So I think, as Nigel, I just mentioned that now the opportunities are pretty much limited, but we have been looking at this whole mid and small cap space, and
Yes.
I think that considering the growth opportunity over there are very high versus the large cap because the businesses are pretty large and mature.
Ajay,
Yeah.
Ajay, if you could give us a couple of themes, a couple of names, that will be helpful, right? Because maybe the headline doesn't go up so much, but as you said, there's plenty of value in some of these stocks. So if you could share some names.
Yeah, sure. So again, if you look at within pharma space only, there are a couple of, smaller names, which are OTC based businesses and focused in US. They are trading still pretty cheap. In addition to that, you'll find pretty much a couple of NBFCs who are affordable housing focused. There also, stocks are trading at 0.5, 0.6 times price to book on a very small base. And my sense is that, going into the festive season, you'll see a lot of action on the affordable housing side. So I think that the loan growth traction can pick up, and these kind of valuations of 0.5, 0.6 are not sustainable. So as I said that, both on the consumption side as well as on the export driven side, we are finding lot many opportunities which can compound at maybe 25, 30%. So broadly, we are focused right now more on the mid and small cap side where the opportunities are still plenty versus the large cap side.
You spoke about autos and how you like the numbers, the ones at least which came out. What about tires? Tire numbers were pretty strong in Q4, at least most of them. Do you think that's a bit of a secular structural trend? We could continue to see strong numbers from tire companies?
Yeah, Rima, I think, we have been pretty positive and we own a couple of tire names since a year, and they have done exceedingly well for us. And we continue to maintain a positive view over there. If you look at, the stocks like CEAT and Apollo Tire both, there has been a reasonable change within the industry dynamics. So if you look at, earlier the largest player would command a significant premium, and, the way the industry work was very different. But now, over last 1.5 year, there has been a reasonable pricing discipline, and most of the companies, they have expanded their product portfolio where the margins are also better. So my sense is that, if the crude prices and the raw material prices stays where they are, because they are heavily dependent, the gross margins are heavily dependent on the raw material prices. My sense is that, both these names, CEAT and Apollo Tire, have a significant upside from here on as well. Because if you look at the structure itself, the entire export opportunity has opened up in a pretty big way for these two guys. And considering that, the capacity has also increased sharply, the operating profit growth can be pretty significant. So my sense is that, both these companies are still in a very, fairly better position to deliver a higher earnings growth from here.
Okay, got that. Ajay, good chatting with you. Slightly shorter chat today, but appreciate you joining in on the show. Well, that's a view coming in from Nuvama. By the way, quite a few moves in the market. First, we should look at some of